Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the complete collection of Howard Marks's writings, spanning decades of wisdom distilled into those legendary client memos.
And this is so much more than just a collection of market predictions, isn't it? It's a deep, a really durable philosophy of how to approach capital markets.
That's the perfect word for it, durable. Marx provides this critical non-consensus framework for understanding human psychology, market extremes, and institutional behavior.
Which are the three things that, genuinely drive long-term investment success?
Or
Failure.
Absolutely. And when we talk about durable wisdom, we're essentially talking about the operating manual for Oaktree Capital Management, one of the world's most consistently successful distressed debt and opportunistic investing firms.
It's their playbook.
It is. So we are structuring this deep dive around 5 core strategic themes that are absolutely central to his work. We really want to synthesize his approach into something highly actionable for you, the listener.
Our mission today is precisely that. We want to move past the superficial summaries you might have heard.
Right.
We're going to delve into Marx's specific definitions of risk and what a defensive strategy actually looks like. We'll explore the need to develop an intellectual edge through what he calls second-level thinking. Then we'll analyze how he navigates market cycles and applies contrarianism. And finally, I think this is crucial, we have to examine the often overlooked difficulty of implementing this disciplined approach in the real world, in an institutionally constrained environment.
Okay, let's lay out that roadmap then.
Yeah.
First, we start with the foundational philosophy. This is how Marx defines risk and defense, which is radically different from the academic norm.
Completely different.
Then we pivot to the intellectual edge or second-level thinking, showing why trying to do macro forecasting is generally, futile.
Fool's errand, most of the time.
Exactly. Third, we tackle market cycles and contrarianism, focusing on those psychological extremes. Fourth is the execution rule, the non-negotiable discipline of price and value.
And then we wrap it up.
We wrap up with a strategic critique on why this profound wisdom is so challenging to actually stick to in the modern investment management landscape.
Sounds like a plan.
Let's start where the entire philosophy begins, risk. If you crack open an academic finance textbook or you listen to the quants, the quantitative analysts who dominate modern modeling risk is a fixed, measurable thing.
A number.
It's volatility or standard deviation. It gives you this neat, easy number to calculate a Sharpe ratio, and it all looks very scientific.
Yeah.
Why does Marx argue so forcefully that this standardized, quantifiable view of risk is just inadequate for real-world, long-term investing?
Well, the academic definition of risk volatility is, like you said, absolute and simple. It measures the fluctuation of a price relative to its mean.
Right.
So if your investment in let's say a deep value stock drops 30% because the market is panicking, the standard model flags that as high risk.
Which makes sense on the surface.
It does, but Marx argues that this fundamentally misunderstands the investor's true objective. Volatility is just fluctuation. It's temporary noise. And for a patient investor, it often represents opportunity, not danger.
So what is the Oaktree definition of risk then? What do they actually lie awake at night worrying about?
They worry about the chance of losing money permanently.
Okay, that's a crucial distinction.
It's everything. Marx notes that risk is not a number. It's a concept, a notion, a worry that capital might not return the expected positive result years down the road. Or, even worse, that your principal might be impaired forever. If you are a long-term investor, a short-term drop in price is irrelevant. Unless you were forced to sell at that low price.
That raises a critical point about Oaktree's structure, doesn't it? Why can a firm like Oaktree, which manages these closed-end funds and has long-term capital commitments, why can they afford to just ignore volatility, while maybe you, the individual investor or a retail mutual fund manager, you really can't?
Yeah, it comes down to liquidity needs and the investment mandate. Oaktree's capital is often locked up for years, typically 5 to 10 years.
So their investors can't just pull their money out on a whim.
Exactly. It means they are not forced sellers when the market dips. They have the luxury of time to let the fundamental value assert itself. If a security drops 20% in a month and the underlying assets or the contractual arrangements are solid, Oaktree just views that as a pricing anomaly. It's not a failure of their investment thesis.
Conversely, if you are a manager dealing with daily liquidity for a mutual fund, that 20% drop means clients might start redeeming their shares.
And that forces you to sell that position at a loss, thus making a temporary paper loss into a permanent one.
So for them, volatility is risk.
It is, because it triggers the mechanism of permanent loss through forced liquidation or redemption pressure. Marx highlights that Oaktree focuses relentlessly on avoiding those perils that lead to permanent capital impairment, things like investing in structurally unsound companies or relying on highly optimistic leverage structures. The goal is always to deliver positive returns over the full cycle, not to maximize short-term volatility-adjusted returns.
This philosophical definition of risk, it leads directly into their core motto, what you call the defensive imperative. What is that credo?
The foundational motto guiding all of Oaktree's activities is, if we avoid the losers, the winners will take care of themselves.
I love that.
It's not just a catchy phrase, it dictates a fundamentally defensive approach, which Marx summarizes as simply investing scared.
Investing scared. I mean, that runs completely counter to the aggressive, growth-focused narrative we often hear, where managers are celebrated for chasing these high-risk, high-reward opportunities. Isn't a defensive posture inherently limiting when the market is rewarding aggression?
That's the tension of the Marx philosophy, and it requires incredible discipline. Defensive investing means constantly worrying about what one doesn't know, and more importantly, worrying about what can go wrong.
So you're always thinking about the downside.
Always.
Yeah.
It mandates building in a significant margin for error. It is a deliberate rejection of what Marx calls the credo of the home run, the idea that you must be willing to accept catastrophic failure, being in the bottom 5% of managers, just to have a shot at achieving massive quick gains and being in the top 5%.
Yeah, the dare to be great mentality.
Yeah.
It often translates into a really high strikeout rate. You swing for the fences every single time, hoping for that occasional grand slam.
Marx advocates for the exact opposite. A high batting average achieved through methodical consistency and the avoidance of those catastrophic strikeouts. He points to players like Steady Eddie Murray.
Oh, great analogy.
Yeah, he drove in at least 75 runs for 20 consecutive seasons. Murray never led the league in home runs, but his consistency delivered massive long-term value. In finance, this translates to avoiding the fads, avoiding the over-leveraged deals, and avoiding the situations where a single unanticipated variable can wipe out years of accumulated gains.
So that consistency, that avoidance of failure, that's what yields outstanding long-term track records.
It is, even if it means you trail the risk takers during the most euphoric market phases. And that's a tough pill to swallow for a lot of people.
I bet. So if the goal is to avoid permanent loss, then the riskiest thing, Marx notes, is the widespread belief that there is no risk. Can you explain that counterintuitive relationship?
This is the key to understanding market cycles and what he calls the vanishing risk premium. Risk is behavioral. When risk tolerance is universally high, when investors are feeling sanguine, confident, maybe even a little arrogant, they stop demanding adequate compensation for bearing risk. They become complacent.
And when investors stop demanding compensation, what happens to prices?
Asset prices skyrocket. I mean, you saw this phenomenon vividly in the run-up to the 2007 financial crisis. Lenders and investors became so confident in the perpetual rise of real estate that they accepted risk without demanding a proper risk premium.
They were buying those residential mortgage-backed securities that were rated AAA.
Right, essentially accepting low fixed income returns for unknown, incredibly complex risks that they didn't really understand.
Or, to use real estate terms, they were accepting minimal capitalization rates. For listeners who might not be familiar with that metric, can you explain briefly why a minimal cap rate is such a clear sign of extreme confidence and a vanishing risk premium?
Absolutely. A capitalization rate, or cap rate, is essentially the expected rate of return on a property based on its net operating income relative to its current market price.
Okay.
So if a building generates $1 million in net income and its price is $10 million, the cap rate is 10%. Pretty simple.
Good return.
A very good return. But if that same building is bid up to $50 million, the cap rate drops to just 2%. A minimal cap rate means you are paying a maximal price for the current income stream, and you are betting heavily that appreciation or income growth will bail you out.
You're counting on the future being perfect.
You are. When prices require you to accept a minimal cap rate or buy stocks at high PE ratios of 40 or 50, Marx views that investment as dangerously overpriced because the market has agreed the asset is safe and has unlimited upside potential, which means the necessary margin of safety is just gone.
So high risk tolerance equals high prices and low future returns. It forces us to conclude that risk aversion, not risk tolerance, is actually the investor's greatest defense.
Precisely. When risk aversion is high during a panic or a recession, assets are cheap and future returns are inherently higher because you are demanding compensation for fear. The market is constantly moving between these two poles, but the periods of highest actual risk are paradoxically those where investors feel the safest and are most willing to throw caution to the wind.
So Marx establishes this defensive capital preservation mindset. But just preserving capital isn't enough. You still need to generate alpha, you need to generate returns. So how does a defensive investor gain an intellectual edge?
Right.
Most of the investment world is obsessed with macro forecasting, guessing the direction of interest rates, inflation, or the S&P 500 next year. Yet Marx treats macro forecasting with immense skepticism. Why does he view this pervasive industry endeavor as largely futile?
Well, it's a paradox of modern finance, isn't it? Everyone wants to predict the future, but the probability of being right consistently enough to generate superior returns is vanishingly low. Marx lays out 3 iron laws that doom most macro forecasts.
Okay, what's the first law?
The first is simply the low probability of being correct. The expected value of a forecast is the potential gain multiplied by the probability of being right. If the outcome is only marginally better than a coin flip, the expected value is negligible.
And it's more complicated than just getting the direction right.
Much more complicated. You have to be right not only about the direction of the economy, but also about the market's reaction to it. If you predict high inflation, but the market has already priced in even higher inflation, you still lose money. The level of specificity required is it's paralyzing.
And the second law relates to extrapolation, right?
Yes. Marx finds that most forecasts are just simple extrapolations of the recent past. Forecasters tend to predict a future that looks almost exactly like the last 6 months, only slightly more or slightly less extreme.
They fail to anticipate the big shifts.
They fail to anticipate the sea changes. Think back to famous wrong forecasts. In 1979, Businessweek famously published The Death of Equities, predicting a long-term shift away from stocks.
Just before the greatest bull market in history began.
Exactly. Or, many forecasters in 2007 simply extrapolated the rising trajectory of home prices. When the current trend becomes consensus, it is inevitably wrong because the market is cyclical.
And the third, and perhaps the most painful law for any investor, is timing. Even if you nail the direction, if you're early, you're just wrong.
Absolutely. Marx says being too far ahead of your time is indistinguishable from being wrong. Let's say you correctly forecast in 2021 that certain hypergrowth stocks were unsustainable. If you sold then, and the market continued its frenzy for another year,
You'd look like an idiot.
you'd look like an idiot and you'd incur what is called tracking error. Your fund lagged the benchmark, potentially losing clients, even though you were eventually proven correct. You need to be right about the direction, the magnitude, and the timing. It's a 3-legged stool where if any leg breaks, the whole investment falls apart.
So if the intellectual edge isn't found in attempting to predict the entire market, where should investors focus their energy? Where does Marx tell Oaktree to know the knowable?
The strategy is to eschew those macro forecasts and instead focus intensely on micro situations where hard work and superior in-depth insight can genuinely yield an advantage. Marx directs energy toward inefficient markets.
Okay, define those inefficient markets. What makes them so prone to mispricing?
These are markets subject to biases, fear, panic, or where non-economic motivations hold sway. They're often niches that are too complex, too unseemly, or too arcane for large conventional investors to even bother with.
So this is the bedrock of Oaktree's history.
It is. High-yield bonds in the late 1970s, distressed debt in the late 1980s, convertible securities. When conventional investors label an entire asset class as junk or too risky, fear creates this vacuum of price discovery and inefficiencies just bloom. The edge comes from knowing everything about a small number of things rather than knowing a little about everything.
This emphasis on superior, non-consensus insight leads us directly to that famous concept of second-level thinking. How does a second-level thinker operate? Can you give us a concrete example of that thought process?
Sure. First-level thinking is simplistic and superficial. It's instantaneous. It's company X reported great earnings, therefore I should buy the stock.
The immediate gut reaction.
Exactly. Second-level thinking requires asking these difficult, probabilistic questions that counter the consensus.
Like what?
Okay, a second-level thought process on Company X would sound more like this. Company X reported great earnings, the market is celebrating, and the stock is up 10%. But is this company already considered great by everyone?
Okay.
Yes. Is the price already reflecting future earnings that assume 50% year-over-year growth for the next decade? Yes. Is that growth trajectory competitively or mathematically sound? Probably not. The consensus is too optimistic. Therefore, even though the company is great, the stock is currently overpriced and I should sell it, or at least avoid it.
So the edge isn't in predicting success. It's in predicting how the consensus misprices that success.
That's it exactly. The intellectual edge requires understanding the consensus view, realizing that this consensus view is already baked into the price, and then formulating a non-consensus view that is likely to be more correct. If you follow the consensus, you are guaranteed average returns minus fees. To be superior, you must be right when everyone else is wrong, or right in a way they just haven't considered.
This requires immense skepticism and humility, doesn't it? Which is where the, school of investing becomes this necessary defense mechanism.
It really does. Marx draws the stark contrast between the I know school and the I know school, the confident forecasters. They think they have all the answers and act with total certainty. The I don't know school, the cautious skeptical group, they recognize the massive uncertainty surrounding the future and they prioritize downside protection.
He has a great quote about that.
He does. He often quotes Amos Tversky, who said, "It's frightening to think that, by and large, the world is run by people who have faith that they know exactly what's going on."
That sentiment provides a powerful guardrail against bubbles then.
A huge guardrail. Skepticism forces the investor to interrogate the prevailing narrative. If it sounds too good to be true, whether it's the dot-com valuations of the late 90s where growth was assumed forever, or market-neutral funds promising absolute returns regardless of the environment, it probably is.
And humility forces you to ask that hard question.
Right. Humility means constantly asking, am I truly smarter or more right than the millions of other investors whose collective actions have already set this price? Without humility, the answer is usually a resounding and often disastrous yes.
But let's challenge that for a moment. If the market is indeed semi-efficient, how do you reconcile being defensive and humble with the aggressive necessity of placing a non-consensus bet? Doesn't second-level thinking still require an extraordinary amount of confidence in your own analysis?
That's a great question. It requires confidence in your process, not in your ability to predict the future. Marx isn't saying, don't analyze. He's saying, don't assume. The confidence comes from the microanalysis. Knowing the collateral, the covenants, the industry fundamentals, and the contractual rights in your specialized niche better than anyone else.
So the confidence is in the details, the knowable stuff.
Exactly. Your confidence stems from the deep, knowable details, which allows you to tolerate the short-term macro noise. The humility is recognizing that you might be early, and that you must build a margin of safety to survive the macro environment being even worse than you anticipated. So it's a specialized confidence backed by detailed research, but it's constrained by macro humility.
Okay, so if we accept that macro forecasting is fraught with peril, and that superior returns require this non-consensus thinking, we have to then grapple with the central driver of non-consensus opportunity cycles. Marx's writings are just saturated with this idea that the market is a pendulum, swinging constantly between extremes.
It's the constant rhythm of the investment world, and Marx stresses that these cycles are fundamentally psychological, not merely economic. The market pendulum swings between euphoria and depression, between celebrating every single positive development and obsessing over every negative one.
And the critical insight is where that pendulum spends most of its time.
Exactly. The pendulum spends much more time at the emotional extremes, either wildly overpriced or drastically underpriced, than it does resting at the happy medium of fair valuation. These extremes are the source code of investment opportunity. They are created when fear or greed overrides rational, objective analysis.
Can you give us a vivid example of a market extreme creating that kind of opportunity?
Oh, for sure. Consider late 1990. Driven by the Gulf War uncertainty and some domestic economic concerns, this exaggerated risk aversion just swept the markets. Investors became deeply, deeply afraid of anything less than gilt-edge quality.
Everyone ran for safety.
Everyone. This psychological extreme led to the drastic undervaluation of nearly all non-investment grade securities. Marx notes that Oaktree was able to step in and buy assets at fire sale prices precisely because of this pervasive fear. When valuations eventually swung back toward a more rational equilibrium, not even euphoria, just equilibrium, it resulted in one of Oaktree's best quarterly performances in its history.
And that surge proves the power of the cycle just reversing from a psychological low point.
It does.
To help the listener recognize where we might be in that emotional swing, Marx outlines the 3 predictable stages of a bull market. We need to internalize these to avoid the inevitable third stage crash.
These stages are absolutely essential for identifying the danger zone. The first stage is characterized by deep skepticism. Only a few far-sighted non-consensus people believe improvement is even possible.
The news is still grim at this point.
The news is terrible. Assets are at their cheapest, and only the most astute and daring investors are buying, often facing criticism from their peers. The behavioral marker here is this is too risky.
Then the consensus starts to catch up.
Yes. The second stage occurs when most investors agree that improvement is underway and it's starting to show up in the statistics. Prices rise to reflect fair value, which requires less imagination and less emotional courage to buy. The behavioral marker is, this looks sensible.
And then comes the danger zone.
The third and most dangerous stage is when everyone believes everything will get better forever. This is the giddiness phase. Investors ignore the economic, credit, and corporate life cycle, and they just extrapolate gains indefinitely. They forget that competition exists and that technological progress can lead to disruption. The behavioral marker is, there is no price too high, and this time is different.
That third stage is where the delusion that trees will grow to the sky takes hold, ignoring the basic economic reality that perpetual, unimpeded success is impossible.
Exactly. Look at the late stages of the tech bubble leading into 2000. Investors paid prices, assuming guaranteed, exponential success. They completely overlooked fundamental forces. The fact that profitability attracts competition, which inevitably cuts into margins, and that technology itself moves quickly enough to render current leaders obsolete. They invested based on a belief in uninterrupted trajectory, which markets simply don't sustain.
So, if cycles are inevitable, how does one apply contrarianism practically to exploit these extremes? How do you actually lean away from the crowd when it feels so uncomfortable?
Marx is very clear. Superior performance demands non-consensus behavior. You must buy when people are afraid, when the outlook is grim and prices are lowest because it looks like the cycle will never turn up. Conversely, you avoid holding at the top by refusing to succumb to the popular delusion of endless growth. You have to be prepared to be lonely.
Right, because what everyone knows is already priced in.
Okay.
If you follow the consensus, you are guaranteed an average return at best.
That's the core critique of consensus. Marx points out that if the consensus is right, the return will be average. To achieve a superior return, you have to formulate a view that is more right than the average investor, and that view is necessarily non-consensus.
And this often means investing in things the crowd finds distasteful.
Or just boring, things they deem arcane, unseemly, or risky. Marx famously pointed to high-yield bonds in 1978 or distressed debt in 1988 asset classes that were shunned by major institutions but offered these, free lunches because the fear and complexity had created massive market inefficiencies.
But the psychological strain of contrarianism is immense. I mean, if you're buying when the market is plummeting and selling when everyone is cheering, you are guaranteed to look wrong for a long time.
Yeah.
How does Marx advise dealing with that immediate tracking error?
This is where that defensive mindset we talked about in Section 1 is so crucial. Marx advises that being prudent means accepting that you might be early. Your defense mechanism is the margin of safety, that low price you paid. Being early only becomes dangerous if you bought without that margin.
So you sacrifice some upside to protect the downside.
You do. Marx teaches that it is infinitely better to trim your holdings or exit too early when prices are high than it is to buy into the mania just before the inevitable collapse. You sacrifice the last 10% of the gain to avoid the 50% loss that follows. That's the defensive trade-off.
And the final point on cycles. They repeat because the psychology repeats. History doesn't repeat, but it certainly rhymes.
Absolutely. New technologies and new assets emerge, AI, crypto, NFTs, whatever's next, and the same psychological cycle of fear, greed, and extrapolation plays out every single time. The investor who understands the behavioral history of cycles has the greatest competitive advantage because they can recognize the signs of psychological extremes in novel situations.
So understanding cycles and having a non-consensus view only gets you halfway there. The other half is execution. Marx states clearly that the necessary discipline requires an unwavering focus on valuation. The relationship between price and value is paramount.
This is the execution rule, and it is completely non-negotiable. You must estimate the intrinsic value of an asset and compare that to the price you are asked to pay. Marx's famous maxim encapsulates this perfectly. No asset is so bad that there's not a price at which it's attractive.
And no asset is so good that it can't be overpriced.
Exactly. Ignoring this price-to-value relationship is the primary repeatable path to financial ruin.
This relentless focus on paying less than something is worth It leads directly to the core tenet of defensive execution, the margin of safety.
The margin of safety, popularized by Graham and refined by Buffett, is just vital to Marx's philosophy. It means purchasing assets at a price low enough that they can generate a profit or at least avoid a loss, even if things go wrong. You should never, ever pay a price that presupposes or relies on conditions going perfectly right.
So the margin protects against two things then, a wrong valuation and an unforeseen event.
Precisely. It protects against two types of risk. The risk of analytical error, you might have miscalculated intrinsic value by 20%, and the risk of the unpredictable. Think about the market volatility following the September 11th attacks, or the sudden unprecedented spike in interest rates in 1994, which crushed complex leveraged bond vehicles known as inverse floaters.
Things no one saw coming.
No one. If you bought assets cheaply, those exogenous shocks hurt, but they don't bankrupt you. If you paid full price, or worse, borrowed to pay full price, those shocks are fatal. The margin of safety is your financial shock absorber.
And this discipline completely collapses during market manias, where the focus shifts entirely away from price and towards some vague, often unattainable future potential.
Right. The mania phase is defined by the platitude that there is no price too high for the next disruptive technology or the next guaranteed winner. Marx uses two specific historical bubbles to illustrate the catastrophic cost of forgetting valuation discipline.
Okay, let's start with the late 1990s tech bubble. The Akamai IPO is a stunning example of price completely divorced from value.
It's an indictment of third-level thinking, really. Akamai Technologies had its IPO priced low, yet the price immediately soared, reflecting this feverish optimism. This company, which famously lost $28 million on just $1.3 million in sales.
That's an incredible ratio.
Incredible. It reached a market capitalization of $29 billion. Investors were focused entirely on eyeballs, website traffic, and the promise of future disruption, not on current business reality or the massive amount of capital that would be required just to survive.
So how did investors rationalize this? Why would you pay $29 billion for a company losing $28 million?
Well, they believed the business was fundamentally different and immune to classical competitive pressures. They assumed the company would achieve massive scale and eventually become a natural monopoly, allowing them to charge astronomical prices later on. In short, they used ridiculously low discount rates and fantastically high terminal growth assumptions in their mental models, if they bothered with models at all.
The price reflected success guaranteed forever.
A classic violation of the core execution rule. The collapse, where many of those tech stocks lost 90% or more, proved the cost of that valuation vacuum.
And this wasn't an isolated event. It was a repetition of the Nifty 50 craze decades earlier. Explain that crucial lesson for us.
The Nifty 50 in the late 1960s and early 1970s were 50 blue-chip growth stocks companies like Kodak, Xerox, and Coca-Cola that were deemed so reliable that they were called one-decision stocks.
Just buy and hold forever.
Exactly. The belief was simple: buy them, never sell them, and ignore the price. Investors were paying PE ratios of 80, 90, or even 100 times earnings. They were paying today for decades of distant, highly optimistic future growth.
The consensus was that these companies were so strong nothing could go wrong, so valuation just didn't matter.
It didn't matter. But the crash of the early 1970s proved that valuation always matters. Even fundamentally great businesses cannot support infinite price-to-earnings multiples. Many of these Nifty 50 stocks saw massive collapses, with some never recovering their prior peaks. And of course, companies like Kodak eventually faced existential crises. Marx emphasizes that no technological development, no matter how revolutionary, is so significant that its stock can be purchased regardless of price.
So if you're a deep value or defensive investor like Marx, how do you manage the psychological pressure of watching everyone else make money during that mania phase, knowing your discipline is keeping you out of the action? It must be agonizing.
It is the most painful test of the execution rule. Marx advises constantly returning to first principles. What is the asset worth, and what am I paying? He accepts that during the boom, Oaktree will trail the risk takers. That is the price of their defensive strategy. Their goal is not to maximize returns during the bubble, but to maximize returns over the full cycle, which means ensuring survival and massive outperformance during the inevitable bust.
So discipline means adhering to the valuation metrics, even when they feel unpopular or painful.
Especially when they feel painful.
It is so easy for us to read Marx's memos and nod along. Be defensive, be contrarian, buy cheaply, be humble. But implementing this wisdom in the real world, especially for institutional investors managing billions, seems incredibly difficult. What are the key organizational constraints that undermine the disciplined application of Mark's philosophy?
The biggest hurdle is the expectation of conformity. Contrarianism demands maintaining an unconventional investment profile that often looks downright imprudent to conventional wisdom and institutional peers.
Like,
For a manager, taking an idiosyncratic, non-consensus position, say, holding massive cash reserves or selling growth stocks during a boom, exposes them to severe headline risk. If the boom continues, they look wrong, they underperform the benchmark, and they risk losing their capital and their clients.
and the decision-making structure within these big firms only amplifies this problem. Tell us about the committee problem.
The committee problem. It basically dictates that committees rarely embrace idiosyncratic opinions. And why? Because group decisions diffuse responsibility.
There's safety in numbers.
Exactly. If a lone manager takes a non-consensus position and it fails, that manager is criticized or fired. If a committee makes an average benchmark-hugging decision and it fails, no single person is truly blamed. They prefer safety in numbers, and they often manage toward peer allocations. This ensures they won't underperform the pack enough to be fired, but it simultaneously guarantees they won't outperform enough to be truly superior.
It's designed for survival, not excellence.
Perfectly put. Capturing that lone, brilliant, nonconformist viewpoint is fundamentally difficult in a bureaucratic, consensus-driven environment.
This leads directly into the tyranny of short-termism, which is perhaps the greatest enemy of defensive investing.
Absolutely. The investor knows the long-term cycle dictates buying cheap and selling high, but the institutional manager is measured quarterly, or at best annually. This dynamic was perfectly captured by that infamous Chuck Prince, quote, then CEO of Citigroup, right before the 2008 collapse. As long as the music's playing, you gotta get up and dance.
So Prince was admitting he understood the risk that the music would stop, but he felt compelled to participate anyway.
He understood the penalty for being too far ahead of your time. If he had adopted a conservative stance and sat out the real estate boom, Citigroup would have lost market share, and he likely would have lost his job sooner, even though sitting out meant avoiding the 2007-2008 disaster.
It's a terrible dilemma for the manager.
It's severe. Their incentive is often to maximize short-term relative performance, even if it compromises long-term stability. Too many investors think of the long run as just a series of short runs, prioritizing being right now over being protected later.
So, if the constraints are this severe institutional conformity, benchmark hugging, and short-termism, how does Marx advise investors to mitigate these pressures? I mean, is it even possible to be a contrarian within a conventional framework?
He suggests focusing on specialization and having the organizational courage to define your peer group narrowly. If you manage a distressed debt fund, you are compared to other distressed debt managers, not the S&P 500. This focus allows you to justify non-consensus moves based on fundamental analysis in that niche.
But that's harder for a generalist.
It is. For a diversified large-cap manager, the primary advice remains behavioral. You must educate your clients, or yourself, that outperformance requires periods of underperformance. You have to articulate your defensive mandate clearly, defining risk as permanent loss, and accepting that you will lag when the market is euphoric. It is all about managing expectations before the crisis hits.
Given all these constraints and the painful lesson of history, what's the enduring value of studying these cycles and the history of investor behavior? Why bother if implementation is so organizationally painful?
Because history doesn't repeat itself, but it rhymes. Marx emphasizes that investors make the same core mistakes over and over, usually in new fields or new assets. The fundamental human lessons, greed, fear, and the misuse of leverage, are constantly forgotten.
We mentioned the long-term capital management, or LTCM, failure earlier. This is a perfect example of intelligent people forgetting history. Remind us what LTCM was and how it exemplified forgetting the difference between probability and outcome.
LTCM was founded by Nobel laureates and Wall Street veterans in the 1990s. They used these sophisticated mathematical models and massive leverage, at times 25 to 1 or more, to execute arbitrage trades.
So these were the smartest guys in the room.
They were, and their models relied on the idea that highly improbable events, like the spread between similar government bonds widening dramatically, should never happen. The probability of catastrophic failure was mathematically tiny.
But the tiny probability eventually materialized.
Correct. The 1998 Russian financial crisis caused those improbable bond spreads to widen massively. Because LTCM was so highly leveraged, they faced margin calls they just couldn't meet. They forgot that probability is not the same as outcome.
They bet the ranch.
They did. Marx warns that highly leveraged investments financed with bridge loans fail repeatedly, not because the people are stupid, but because they assume that the future will operate within the constraints of their model. When you bet the ranch, you are assuming a certain outcome, not just a probable one, and highly improbable disasters sometimes do occur.
So the key to enduring success isn't forecasting the future, but recognizing the signs that others are getting reckless and ensuring your own structure can survive the volatility they create.
Precisely. Marx's enduring advice is structural. Focus on avoiding pitfalls first. Invest in specialization based on in-depth analysis and conservative valuation, and accept that you will trail the consensus during the hottest phases. When confidence is low, risk premiums are high, and that's the time to act aggressively. But when everyone else is confident, you should be terrified. When you prioritize loss avoidance, the eventual swing of the cycle ensures the winners will take care of themselves.
That brings us to a final provocative thought, something to leave you with as you consider where the pendulum stands today and whether fear or greed is currently dictating prices.
The cycle will turn, just as it always does. Remember the quote from the English economist Arthur C. Pigou, which Marx uses to frame the perpetual nature of market psychology. The error of optimism dies in the crisis, but in dying, it gives birth to an error of pessimism. This new error is born not an infant, but a giant. This reminds you that investor psychology, the massive swing from euphoria to despair, is always the primary driver of market inefficiency, and therefore it is the primary source of future opportunity for the disciplined, defensive contrarian.
Risk defined, portfolio protected.